Welcome all. So, now we are in the last leg of this discussion on the estimation of the cash flows in the capital budgeting decisions, and this is as I told you in the previous class, we are going to discuss one more problem, which is basically the replacement decision, means the replacement of the old asset with the new asset because of certain means the changes in the market or because of certain changes in the technology. Many a times firms have to say replace their assets, maybe the say old assets with the new assets. It may not be the case that the asset has become obsolete or maybe the technical value has become 0, it is not the case. But it may be the situation that if we replace the old asset with the new asset, it is going to give us the better revenue, means our savings are going to increase, our cost of production is going to decrease, and sometimes the quality of production which comes out of the new asset or by using the new asset may be much better. So, it may have a better place in the market, better acceptance among us the buyers or the customers, right. So, if there is a situation that we have to take the replacement decision, because if the sum required for replacing the old asset with the new asset is quite bigger, quite higher. So, it means certainly it also comes in the category of the capital budgeting decision. So, again we have to evaluate it in the same manner how we normally take the normal capital budgeting decisions in case of the new assets, new projects or the fresh beginning of any business activity or adding up of a new product into the existing product line. So, it is an independent capital budgeting decision. Only difference is that whatever the cash flows we work out here, they are incremental cash flows because something is already existing with us. So, we have to replace that with something new. So, the good and bad effect of the old thing or the old assets also have to be kept along with the say the positives or maybe the negatives of the new thing we are putting in place. So, ultimately it is going to be something called as a incremental. So, we are going to calculate the incremental cash flows, that is the only difference in the replacement decisions. Otherwise, the estimation of the cash flow process is same. We try to find out that how much cash outflow is going to be there in the current period, in the 0 period, and how much cash inflow is going to be there over the coming years, foreseeable life or useful life of the asset. Same way we are going to do, and ultimately we begin with the investment outlay in the current period and we end up with calculating the net cash flow which will be available out of this replacement decision, right. So, let us do it, and like as we have seen the previous problem in the previous class, now I will again read this problem for you so that we can understand the problem well and then we can calculate the cash flows. So, what is the problem here? It is a simple problem. Raja Engineers is considering a proposal to replace one of its hammers. It may be a technical asset or a machine. The following information is available. Number 1, the existing hammer was bought 2 years ago for 1 million rupees. It has been depreciated at the rate of 33 and 1 by 3% per annum. It can be presently sold at its book value. It can be sold at its book value. So, you have to calculate the book value, that is the say depreciation. The total is 10 lakh rupees, the purchase price for which it has been purchased, and the depreciation rate is 33 and 1 by 3% per annum. Method is the written down value. So, you have to calculate the depreciation for 2 years on the WDB method and then calculate the book value, and that is the value which can means this asset can fetch from the market if it is disposed of after means acquiring the new asset. It has a remaining life of 5 years, after which on disposal it would fetch a value equal to its then book value, right. Today after 2 years the book value is different and after 5 years the book value is different. B, point number 2, the new hammer costs 1.6 million. It will be subject to a depreciation rate of 33 and 1 by 3%. After 5 years it is expected to fetch a value equal to its book value. Again means fetch a value after 5 years, it is expected to fetch a value which is equal to its book value, because we have to calculate the terminal cash flows. So, this amount is important. The replacement of the old hammer would increase revenue by 0.2 million or 2 lakh rupees and reduce its operating cost excluding depreciation by 1.5 lakh per year or 150,000 rupees per year. Now, what you have to do it on the basis of it? We are given both the informations. We are given the information about the old asset also. We are given the financial information about the new asset also. We are given the information about the savings in terms of the cost also and the increase of the revenue also. So, what you have to do now? Required is compute the incremental post tax cash flows associated with the replacement proposal. Compute the incremental post tax cash flows associated with the replacement proposal, assuming a tax rate of 50%. Assuming a tax rate of 50%. So, now our job is that we have to evaluate this replacement decision, capital budgeting decision, but before that, at this particular point we have to only estimate the cash flows. Later on, as a next step, we can discount the cash flows, both outflow and inflow, if it is in the subsequent period. The outflows are in the subsequent period also, and then we can calculate the NPV out of this decision, and then finally we can decide whether to go for this particular decision or not. So, now let us calculate the cash flows. So, same way I am proceeding further. For this case, we are going to calculate the cash flows. So, we write here cash flow for replacement project or the replacement decision. Cash flow for the replacement project or the replacement decision. And similarly, we are going to have the columns like here is the particulars, then we are going to have the years, particulars and years, we are going to have the same years, we are going to have the 0 year, then we are going to have 1, 2, what is the life given here? 5 years, 3, 4 and it is 5, right. So, first item is as usual, first item A is the net investment in the new hammer, net investment in new hammer. We have to now calculate the net investment in the new hammer, because what is the cost of new hammer? 16 lakh rupees, 1.6 million rupees, but I have calculated here it is, that is 11 lakh 55,000 55,556, 11 lakh 55,556, and what is written here? Net investment in the new hammer. It is not investment in the new hammer, it is a net investment in the new hammer. So, how we have arrived at this figure? I would like to explain it to you, that what is the say cost of the new hammer? 16 lakh rupees, right. This is the cost of the new hammer, 16 lakh rupees, but this we are not going to, we are going to shell out 16 lakh rupees to purchase, to pay it to the supplier, but we are going to get back something as the book value of the old hammer. So, we have to first calculate the book value of the old hammer, and if you calculate the book value of the old hammer, so what is the cost of the old hammer? That was acquired for the 10 lakh rupees, 1 million rupees, and what is the depreciation rate? At the rate of 33 and 1/3%, it has depreciated at the rate of 33 and 1/3%, and for a period of how many? 2 years. So, you have to calculate the depreciation on this 10 lakh rupees for a period of 2 years by say applying the, or by following, or by adopting, or by working on the WDV method, written down value method, and finally, if you calculate that depreciation, so the book value which you will be arriving at after subtracting the depreciation for the 2 years on the written down value method, the book value you will be arrived at is 4,44,444. This is the book value of the old hammer. So, it means this book value can be realized after selling this hammer in the market as a second hand machine, and once we are shelling out 16, but we are getting back 4,44,444. So, what is the net investment we are making? We are making the net investment of 16 lakhs minus 4,44,444. This investment we are the total investment we are making, and this works out as the same amount here, that is 11,55,556. 6. So, we have to calculate the net investment, incremental investment. We have not to say calculate the only investment. So, that is a very important consideration here. So, I will remove all this because this I did for explaining it to you. Now, we will move to the next part because this is the cash outflow in the 0 year. So, here nothing, we are not doing anything here because no inflows are coming in the 0 period. So, it means nothing here, only we are going to shell out additional 11,55,556. Now, what is going to be the effect of this change in the machine? B is the increase in revenue, increase in the revenue. How much increase in the revenue we are going to have? Increase in the revenue we are going to have here is 2 lakh rupees. It is given to us 2 lakh rupees. Its increase in the revenue is 2 lakh rupees. Net increase in the revenue is 2 lakh rupees every year for the 5 years period of time. That is why we are going to have the better machine. So, it is 2 lakh rupees, right. That is increase in the revenue, right. Third important component is the savings in the operating cost, saving in operating cost. How much saving in the operating cost is going to be there? We are going to save some amount called as 150,000 rupees, 150,000 rupees we are going to save. It is 150,000 rupees we are going to save, right. These are the for the period of 5 years, right. Next thing is now depreciation. We will have to now talk about the cost part. Depreciation on new hammer, depreciation on the new hammer, and again the depreciation rate on this hammer is going to be how much? That depreciation rate on the new hammer is going to be at the rate of, that is going to be at the rate of say 33 and 1/3% again, as it was on the previous hammer, the same depreciation rate. So, if you calculate the depreciation on the new hammer, what is the depreciation on the new hammer? The first figure comes up here is 5,33,333, 5,33,333. Then is the next year is the 3,55,555. Then is 2,37,000 depreciation we are calculating on the new hammer as per the WDV method and applying the rate of 33 and 1/3%, and then here it is 1,58,025, and last depreciation is how much? 105,350. So, this is the depreciation on the new hammer. Similarly, if the old hammer would have been not replaced by the new hammer, then it also would have given us some inflow in terms of the depreciation. So, now we have to calculate the depreciation on old hammer because we have to calculate the incremental depreciation only. So, the depreciation on the old hammer is how much? 148,148 again, then it is 98,765, then it is 65,844, then it is 43,896, and then it is 29,264. This is on the old hammer, the depreciation. So, both the depreciation figures we have calculated, and finally, what is the incremental depreciation? Incremental depreciation is how much? Incremental depreciation here it is, that is this minus this, D minus E. So, incremental depreciation is going to be 385,185, right. Then it is 2,56,790, then 1,71,193, then it is 14, if you may subtract the other one from the other, then it comes as 114,129, right, and then it is 79,086. This is the incremental depreciation, or this is the differential depreciation you can call it as. This is the incremental depreciation we have to calculate. So, incremental depreciation we have calculated, which is the figure of importance for us. This is the incremental depreciation we have calculated, that is depreciation on the new hammer and minus the depreciation of the old hammer, and the incremental figures we have arrived at, we have worked out here, right. Now, G is incremental taxable profit, incremental taxable profit. How much is going to be the incremental taxable profit? Now we have to calculate, because we have to find out here, that is the savings are 3 lakh, this 2 lakh plus 150,000, 3 lakh and 50,000. So, out of this we are going to subtract some amount. So, this amount is going to be how much? 35,000, 35,185, 35,185 is going to be the say taxable profit, but this is not the profit, actually this is the loss, because the say total amount which we are going to have the saving upon, that is the increase in the revenue is 2 lakh rupees, saving in the cost is 150,000 rupees. And when you talk about the incremental depreciation, so incremental depreciation as a cost, because ultimately the depreciation is a cost, which is 385,185. So, this is the difference, that is the difference is coming up as 35,185. This is the loss we have calculated here, this is the loss. And then the incremental profit in the next case is going to be how much? The incremental profit in the next case is, which is the incremental taxable profit. We have to write here incremental taxable profit here, and for calculating this incremental taxable profit, in the first case it is 35,185, which is a loss, not a profit. In the second case it is 93,210, and in the next case it is 178,807, and then is the taxable incremental taxable profit 178,807, and then is 235, 2 lakh 35,871, and then it is a 2 lakh 73,914, 2 lakh 73,914. So, this is the taxable profit, or in the first year there is a taxable loss, means there is no profit at all, and the loss is to the tune of 35,185, and in the next year there is a profit 93,210, and then it is next year it is 178,807, then it is 2,35,871, and then it is a 273,914, right. Now, we have to calculate the incremental tax. So, it is the incremental tax we have to calculate. So, for calculating the incremental tax, now what is the tax rate given here? The tax rate given here is the say 50%, right. So, we have to take this incremental tax, we have to calculate. So, if you calculate it at the rate of 50%, what is the rate given here? That is the 50%. So, we have calculated the incremental taxable profit, which is 35,185, which is a loss in the first year, no profit, but in the other 4 years, 2, 3 and 4 years, there is a 4 and 5 year, there is a profit. And now, the incremental tax at the rate of 50%, incremental tax at the rate of 50% we have to take here. So, because the tax rate given to us is 50%, and if you calculate the tax on this rate at the rate of 50%. So, it means what is the total incremental taxable profit or loss. So, and if we apply this, so this works out as how much? 17,593, and in the other years we have to take as the 46,605, and the one more is 89,403, and then it is incremental this incremental tax we have to take here as 17,593 in case of the first year, which is the loss, but the tax savings will be this much amount, and then in the second year there is going to be the tax at the rate of the 46,605, and in the next year it is going to be how much? 89,404, 403 or 404, we take it as the 403, and or we take it as the 404, and then later on we will take it as the 403. So, this is going, because it is 50%. So, 89,404, and next case it is going to be 1,17,936 is the incremental tax, and then it is lastly 1,36,957, right. This is the incremental tax. So, now lastly we have to calculate here is, that is the incremental profit after tax, incremental profit after tax. So, if you calculate the incremental profit after tax, so how much it comes up as? It comes up as 17,592, right. So, it is again the loss, that is the say after this, if you take into account, this is a loss, 17,592 is the loss. In the next case it is going to be how much? 46,605 is going to be the profit after tax, incremental profit after tax, and then it is going to be the again same figure 89,403 is the incremental profit after tax, and then the next case it is going to be again same figure 1,17,936, and or 35 we will have to make it, because there is a difference of 1 rupee. So, we will have to make it 35 here, this is 35, and last amount is going to be incremental profit after taxes, again same amount 1,36,957, right. So, this is the incremental profit after tax we have calculated. Now, we will calculate the net salvage value. Net salvage value, how much is the net salvage value? We have to calculate the net salvage value which is coming up in the last year, 5th year, and this is going to be how much? That is the value left after the depreciation, and depreciation we have to charge for a period of 5 years at the rate of 33 and 1/3%. So, the salvage value is going to be, means the market value which the asset is going to fetch after selling it off in the market after 5 years. So, this is going to be this much, and next thing is the net initial outflow, initial investment or outflow you can say is how much? This is 11,55,556, 11,55,556 is the initial investment we have done, and finally on the basis of this you can calculate the operating cash flow, operating cash flow. So, if we calculate the operating cash flow, it will be the, we will be taking only account the operating part of the firm, and in this case operating cash flow we are going to calculate. So, we have calculated the initial investment of 11,55,556, and the operating cash flow is going to be how much? It is going to be in this case 3,67,593, right, and in the next case it is going to be 3,03,395, 3,03,095. In the next case it is going to be 2,60,596. Next case it is going to be 2,32,000, 2,32,064, 2,32,064. So, this is the one, and 2,32,064, 064, and next thing is 2,13,000, 2,13,043, 2,13,043 is going to be the operating cash flow. And now the terminal value, terminal cash flow. What is going to be the terminal cash flow? Nothing here, nothing here, nothing here, nothing here, nothing here, and we are going to get the same amount, that is 1,52,172 as the terminal cash flow is going to be this, and after all this calculation we are going to find out the last figure and the final figure, which is called as the net cash flow. We are going to find out the last figure, that is the net cash flow, and this is the ultimate objective of doing this all analysis. So, net cash flow is going to be the sum total of all the calculations we have done here. The terminal cash flow we have to add up into the operating cash flow, and then we will be able to find out the net cash flow. So, in this case net cash flow is going to be how much? Net cash flow is going to be in this case 3,67,593. 3,67,593. In this case it is going to be the same figure, no change, 3,03,395, and in this case it is going to be 2,60,596, and in this case it is going to be 2,32,064. In this case only we are going to make this plus this. So, if you make this plus this, it works out as 3,68,215. 3,68,215 is going to be the final amount, is the say the cash flow, net cash flow in the year that is called as the year 5. So, in this case if we look at the total cash flows, the cash outflow which we have worked out is a net cash flow, that is 11,55,556, and in the say over the subsequent 5 years when we have calculated the cash inflows, we have been able to find out that what is the cash flow here. In the first year, though there was a loss, but that loss has been finally has given us because of the depreciation amount. And what was the depreciation amount? That was the say incremental depreciation. When we calculated, it was 3,85,185, and from this when we subtracted the loss figure after say setting aside the tax part, because that benefit will be taking up in the next year from the profits of the next year, the loss of the previous year can be adjusted. So, that benefit will be taking. So, in this whole case, after the whole analysis, at the end of the first year we had the positive cash flow, and that cash flow was 3,67,593, and in the subsequent years you have the positive cash flows anyway. And in the last year the cash flow which we have worked out is, in that the operating cash flow we have added up the say your terminal cash flow also, which is basically the book value. It was given to us that after say buying the machine and using it for a period of 5 years, we have bought it for 16 lakh rupees and used it for a period of 5 years. So, the book value, whatever the book value will be at the end of the 5th year, that will be realizable, that will be the market value also, that will be realizable from the market. So, we have found out that this is the book value of the machine, of the new hammer purchased for 16 lakh rupees, that was 1,52,172. So, at the end of the 5th year, one cash flow will be operating cash flow and second will be the terminal value. So, two cash flows will be available with us. So, finally, if you try to find out how much is the sum total value of these cash flows, it is 3, 3, 6 and 2, 8, and then it is 2, 10, 13. So, I think the non-discounted figures are going to be more than the say the cash outflow, net cash outflow has taken place, that is 11,55,556. But if you discount these figures for the given discount rate or the cost of capital, I am still hopeful that the decision should not be negative. There may be some negative NPV, but simply just say taking the decision on the basis of marginal negative NPV. If this machine is going to give us other say multifarious advantages, maybe as the byproducts, so which cannot be quantified, normally you can call it as they are the qualitative benefits. So, as I discussed in the previous problem, here also I would emphasize upon that after calculating the cash flows, the next thing is calculating the net present value. So, this value will remain the same, but these values we have to discount, and after discounting we have to calculate NPV. So, whatever the NPV comes, normally the rule of thumb says NPV has to be at least 0. So, that cash outflow is equal to cash present value of the cash inflow. So, normally that is a rule of thumb. So that if that rule of thumb is applied by the company in this case, so maybe the decision goes against the replacement of the old asset with the new, but if some other multifarious advantages are also kept in mind, then the management of the company may decide that okay, still we are going for the replacement of the machine because it is going to give us so many other say qualitative benefits, also improve the product quality, customer satisfaction, and anyway the savings are going to be there and increase in the revenue is also going to be there. So, this decision has to be taken in totality, but at this point of time our job was, because we are learning about estimation of the say cash flows in case of the capital budgeting decisions. So, we have done that and we have learned sufficiently, I think, after doing 4 or 5 problems of the different types, that how to estimate the cash flows both outflow and inflow, which will be more relevant, useful for the any kind of capital budgeting decisions. So, with this discussion, I would stop here and I would complete discussion on the say estimation of the cash flows. So, next time we will talk about the new topic, new say part of the discussion with regard to this financial management, and the next topic which I will start talking in the next class onwards is, that is the say management of risk in the capital budgeting decisions or in the capital budgeting say projects, or you call it as management or you call it as the assessment of the risk in the capital budgeting decisions, that I will start in the next class or from the next class onwards. Till then, thank you very much.